There were two primary objectives. The first primary objective was to give the audience an understanding of multi-asset credit. Multi-asset credit is a subject that we are coming across over and over again. It's a product that we think is gaining a lot of traction, particularly with pension funds. It's a specific investment type, an investment philosophy, investment strategy, which I think is tailor-made for the needs of pension funds. The secondary objective of the session was to give the audience some perspective on European credit markets. 2015 has been an incredibly tempestuous year with emerging markets, US credit, and commodities really driving that volatility. But we wanted to just give a framework for where we think European credit markets lie. Well, multi-asset credit sounds like a complex topic, but it really isn't. What multi-asset credit is investing in credit as an asset class, but having the capacity to invest within that into underlying strategies. Within those strategies, you will have the ability to generate beta, as well as generating alpha from stock picking and moving between trends and changing your investment approach within those strategies. But at the top level, what multi-asset credit gives you is the ability to invest in those underlying strategies in different proportions. So a multi-asset credit mandate from a pension fund looks like this. We receive some capital, which we manage, and the way that we manage that is an investment in lots of underlying strategies, maybe 4, maybe 6, dependent upon the capacity of the pension fund and what we've discussed with them. We will, over the top of that, overlay our view on the overall beta within markets, and we will apply a hedging strategy over the top of that. And then within that, we will allocate to our investment teams within those underlying strategies. Now, different asset managers take different approaches. Our approach is to give capital to the underlying strategies and the underlying investment teams. Some asset managers take the approach that multi-asset credit is an investment in all those underlying different asset classes, but managed by a top team, and a team which understands all of those underlying asset classes. We consider that actually we can extract more high-quality alpha by giving it to specialist investment teams within those underlying strategies. So we'll talk about that more over the next couple of years as multi-asset credit becomes better understood. But what I did within the session is to explain what we consider multi-asset credit to look like. And I think this strategy will develop, this approach will develop for us right now. Our multi-asset credit approach is really about Europe and European credit markets and being able to extract value as best as possible in order to outperform the overall beta of credit markets within Europe. And that's what I think multi-asset credit gives you the capacity to do. The basics of multi-asset credit are to look across different strategies within credit, namely financials, corporates, ABS, and to extract as much value as you can from each of those underlying strategies, but to be able to tune in and tune out to those strategies as they move through markets. The key really is to understand the behavior between those underlying strategies and to extract the maximum value while also providing some diversity in order to manage downside and risk. Well, 2015 started reasonably positively after the ECB had announced their QE and the ABS purchase program. And as we entered into 2015, it was looking like we'd have a fair wind behind us throughout the year. But we've really been hit by further commodity shocks, which have led to shocks within emerging markets, and particularly those emerging markets where credit has been expanding, so EM debt has taken a bit of a battering. We've also seen further volatility from Greece, and that's led to more volatility within the periphery of Europe. But actually, the big story for 2015 has been the performance of US credit markets versus European credit markets. So I think European credit markets look a little different, and that's one of the things that we've been emphasizing as we've been speaking to investors around the world, that European credit markets are at a different stage in the cycle. that the credit cycle is really only just beginning, that leverage is starting to tick up. And from a forward-looking perspective, it looks like default rates in Europe will be lower than in the US, predominantly because of the US credit market's exposure to oil. Well, we think multi-asset credit is appropriate for pension funds predominantly because any single strategy will be associated with technicals and fundamentals that can hit that strategy rapidly. What we think pension funds are looking for is steady returns, value in terms of return for the amount of risk that they're taking. And we believe that multi-asset credit can dial in and dial out of strategies as they become more and less attractive. There have been a couple of great examples this year, which I highlighted to the audience, namely the fact that ABS has been a particularly underperforming asset class in 2015, having been the great asset class of 2014 after Mr. Draghi announced the ABS purchase program. We've seen fantastic performance on the flip side by financials, which in 2014 were very volatile, but we've seen the emergence of securities such as A-tier 1s. We've seen the follow-through from the ECB's AQR and stress tests at the back end of 2014, and all of a sudden investors have become more comfortable with financials. So for me, what pension funds can gain from that is an increased exposure to financials from a manager who understands the underlying asset class, and a manager who can say, actually, this looks really great value right now, and this other asset class that looked fantastic value last year no longer looks quite as good value. That leaves the pension fund able to give the latitude to the manager to make those decisions. And in my opinion, and I guess I would say that, wouldn't I, as an asset manager, the asset manager managing those strategies is best placed to be able to say, this is better value than this, while continuing to maintain risk discipline and discipline around diversity. And that's the way in which multi-asset credit can be structured. You can have minimum and maximum exposures, and up tier and down tier your exposures to those strategies as they move through their cycles. First is their tolerance for risk. I think there is risk within credit. There's risk within every asset class, but I think credit is a slightly different asset class in that its return is going to be significantly more stable than you can get from some other asset classes such as emerging markets or equities or commodities. Credit is a steady as she goes asset class in most circumstances, but pension funds, when they look at multi-asset credit, ought to be looking at it as a slightly lower return asset class or slightly lower return allocation than the best performing credit strategy in that year. But one would hope that multi-asset credit will be better than the mean return for that year from credit. So for me, it's about how much appetite the pension fund has to look at strategies within credit and to pick and choose what they think is the best strategy in that year. We think of multi-asset credit as an evergreen strategy for pension funds. And what I mean by that is that the strategy will exist permanently. It can up tier and down tier, as I said, the investment in the underlying strategies, and leaves the pension fund able to step away from the decision about what's the best place within credit to go this year. What's the best place worst place to go with credit this year? Should I be investing? Should I be divesting from those underlying strategies? So before a pension fund allocates to multi-asset credit, they really need to think about what they want to achieve from their credit allocation. Every pension fund should have an allocation to credit, but what are they seeking to achieve from that? If it's moderate returns with low volatility and outperforming the beta of credit more generally, then I think multi-asset credit is the place to go. Well, I think there's been a lot published. I think the consultants have done a great job of trying to understand multi-asset credit, and they've been one of the primary proponents, actually, of multi-asset credit. But I think attending conferences such as this, discussions with asset managers about what they think multi-asset credit means, looking at performance, although performance is not necessarily the perfect predictor of future performance, And multi-asset credit has only really been around for a couple of years. So, that's one of the areas which is a little difficult for pension funds. But I think the last thing for pension funds is that they should really sit down and spend some time thinking about what they want to achieve and see whether multi-asset credit marries up with that. It's actually not as easy a question as you think. When I sit with pension fund trustees and when I sit with the management teams of pension funds, one of the first things I say to them is, what are you looking to achieve? And actually, that's a pretty tough question for some of them to answer. But I think in order to look at multi-asset credit in the round, in the totality, you need to ask yourself that question first, and then the research will come from that. So I think the last thing that I will say on pension funds and what they should do around multi-asset credit is there's a lot of offerings out there. And I'm almost certain that there's one that's tailor-made for every pension fund out there.